Hello and welcome to Protection Strategies. My name is James Boyd. We welcome you here. We got Brett Crowther in the chat. We welcome him here as well. We got many of you here. We got Josh, Ocean Life, Robert, Sim, Frank, Joe, Austin, and many others. Welcome to all. Hopefully you're getting ready for those Thanksgiving festivities tomorrow. It's a great time to actually state what you're thankful for and grateful for. And hopefully you have a good time celebrating with all your friends and family. And this is a good reminder for position sizing, okay? If there's ever a day that maybe you could over position size, maybe tomorrow is it. Not a recommendation, but you might consider that. Now, just real quick as we get started, remember when we talk about, let's say, options carry a high level risk, not suitable for all investors. Also, when we talk about examples and the information we talk about here is provided for general informational purposes only. And also remember that Schwab does not recommend the use of technical analysis as a sole means of research. And also we will be using the paid money software application known as the desktop version for educational purposes. Investing involves risk, including loss of principal. And also remember when we talk about the strategies we do here today, we will also bring up the probability analysis. Now, also in this disclosure, we also do have an example of futures and futures options trading. We're not going to get into futures. I'll mention futures, but that won't be really the focus of our discussion here today. Now, Ben is tied up, and he's asked me to cover this class. I historically used to cover this class, so it feels like old times. Now, many of you might be wondering about my green shirt. I don't think there's any way to kick off the holiday than wearing the green shirt. So, a little fun there. Now, what I want to do is I want to talk about protective strategies. Which strategies? I want to talk about kind of the pros and cons of them. Then we're going to kind of talk about the difference between protecting a portfolio versus protecting a position. And then we're really going to be getting into a collar strategy. And I want to kind of talk about 3 different examples of doing that strategy, how to do it. Okay. Now, first off, let me just do this real quick. So when we talk about protective strategies, okay, first thing we kind of need to just quickly understand is, what are we trying to protect? Well, number one, it could be a portfolio, okay? The other thing it could be doing is we're trying to maybe protect individual stock positions, okay? Now, the biggest thing is when we talk about this, what type of protective strategies are there? So if I were to ask you that question, what type of protective strategies are there? Well, number one is you could go long a put, which means you're buying the put. The pro there, okay, the pro, okay, it limits the risk, limits risk. The con about that is it's a debit. You pay, and also what that is, it's also negative time decay. It also, sorry for that spelling, spelled it wrong, time decay. And also what you're going to notice is it has a low probability, okay? Now, that's a long put. Now, here's the thing is, what is lowers risk, limit risk, excuse me. Now, the one thing with a long put is if you picked, let's say, to buy a put on a stock like SMCI, those puts could also be potentially expensive, okay, as well. Expensive. It could also be expensive when the volatility goes up and you say, no, and the stock falls, and you say, now I'm going to buy a put. Those puts are probably going to be pretty expensive. So the advantage of the long put is you don't have to have 100 shares. So we'll actually put that there as well. Less than 100 shares. Okay, so that's good, okay, but maybe a little bit more cons than pros. Now, when we also talk about, let's say just briefly, short call verticals, okay, short call verticals, I mean, yeah, it's a bear strategy. Long put verticals, okay, yeah, it's a bear strategy. And it is, we would say pros, we'll speak to it. Hey, look, it's a way to try to benefit if the price were to fall or stay neutral, okay? The con about it is not very bearish, okay? Need lots of contracts. And this gets now into commissions, okay? Now, the other thing is when we also take a look at and say, well, what about doing, like, say, a cover call strategy? The cover call strategy, the pro about that is you got income. The problem is, the con is it doesn't limit risk to downside. The other thing that we would actually say with the cover call, really here, is the covered call, the delta varies with price movement. And that's massive. So meaning the delta, so when we buy shares of stock and we sell a call, the delta of that short call is not going to always be the same. And that's leading the investor to have greater potential exposure if the stock were going to go down. Now, how many of you have realized that before? The other thing that is a negative of this, kind of feel like negative wearing a green shirt, but let's just kind of state it anyway. The negative here is that it's short Vega. Okay. Now, when I say that, we also have to go back to the long put. This is long Vega. Okay. So volatility expanded, those puts could become more valuable. If the investor sells a call and they already collected the premium, volatility goes up. Well, it actually can make the call more expensive and numbing some of that time decay you think you're going to get, but it doesn't really materialize like you thought. Now, what happens though if we combine, let's say, a long put and a covered call? Well, if we combine a long put and a covered call, you get down to a collar. Now, the pro about this is if someone says, well, I don't like to buy puts because you have to pay for them. Well, okay, wonder if we did the short call and we actually got a credit. Wonder if we use the credit to actually come down here and buy the long put from the credit of the short call. And what you're going to see is that short call in credit can help pay for some or all of that long put and debit. And the pro about this is, and this is a major one, I'm going to put this in caps, the delta stays more stationary. Ladies and gentlemen, boys and girls, I'm telling you, that's massive, okay? On a lot of strategies, that's not the case, but on a collar strategy, that is one of the major takeaways. The other thing is you really kind of have more neutral time decay, okay? Neutral time decay. It also kind of has the biggest thing that it's really trying to do. The con is, the major con we would say here is it caps the upside potential past where? The strike. The short strike, okay? Now, let me kind of take a step back for just a second. Now, what is also another con about a collar? Need 100 shares of stock. All right, so some people might say, okay, I'm done now, okay? But many of us are probably not done. Maybe it's not a big deal, and you could also choose different types of stocks. Now, when we do a collar, again, we need shares, okay? Shares. And then we're going to sell the call, okay, plus buy the put. Now, in our example here today, activity-wise, what we're going to do is we're going to do it all together, okay, all together. What do you mean all together? Well, we're going to buy shares of the stock, we're going to sell a call, and we're going to buy a put. We're going to do it all together. And we're going to kind of discuss what does the investor want the position to do. We're going to look at the Greeks and the maximum gain and the maximum loss. Second, what we're then going to do is we're going to show what we mean by leg in to a collar, assuming we have the shares already. And why would someone leg into the collar? The technicals become weaker. Okay, we'll talk about that. Third, the other thing is we're going to leg into a collar when the stock goes up to a target price. Think resistance, okay? Now, the other part is, last one is we're going to leg into a collar, okay, when the stock falls below support, okay? Now, how many of you have ever been in a situation where you're like, man, I'm in a position and now that stock is starting to fall below support and I don't really have a plan? That's kind of a problem, okay? So when we get done here today at 45 minutes, we're going to see that we did each one of these. And that means that you should be able to also go out and practice as well. Now, the one thing I want to kind of just do just real quick is kind of talk just briefly about conditions. If we said, well, what are the conditions in the market or the sector or the stock that might make it more conducive to do a collar position? Okay. let's just say market weak. When we say that, we're probably talking about price not being able to get above resistance. Now, when I say market, I could say stock. I could say the sector as well. I'm also going to say that we have maybe red lines on the moving averages. Okay. If we also said, for example, what type of trends? Trends number 4, 5, and if number 1, okay, most likely you are late. Okay, something maybe happened. You're late, and maybe you weren't really paying attention. Okay, so really, when someone does this strategy, they're trying to do it in trend 4 and 5. Trend 4 is when the price is up against resistance above both moving averages. Trend 5 is when the price falls down below the 10, and we just said that. Okay, so the biggest thing is the major point of this: if that momentum, price below the 10-day moving average. So if you start to see that, you're seeing that we're starting to get that bearish momentum and we're falling back. Now, the other thing I want to kind of bring out here is other types of macro, right? Is number 1 is the VIX starts to rise, okay? And we're also going to say that maybe there is a bullish MACD divergence. Okay, so how many of you have seen that before where you're like, James, I was doing really well until the VIX started to go up? This would be more from a US-based perspective. The other one that we would look at from an international perspective, okay, I like to call it the international VIX, okay? And that's going to be looking at a product called 6J, which is the Japanese yen, okay? Sorry for the spell, Japanese yen. Japanese yen is a funding currency, typically, not always. And it's typically a funding currency because it actually has a lower interest rate. So in currency, you go long or you buy a currency and you sell a currency. You're trying to actually get a currency that has a higher interest rate, collect that, and then pay for a currency that you went short and which has a lower interest rate. If the Japanese yen is falling down, that means investors are taking more risk and probably doing more bullish equity positions or currencies in general. However, if the yen is starting to rise, we would think of that as more the international VIX, okay? And if we see that Japanese yen start to go up, which by the way, if you watched this morning, it did, and I'd like to say a lot more on this Japanese yen, but that's not the point of the class, but something I would just kind of be watching. If we're starting to get this to go up, that is probably from a stock-based perspective that we're probably starting to maybe see some more stocks starting to fall back a little bit. That would not be unusual. So if you kind of go back and say, geez, when do I wish I would have maybe considered more collars? It's when the price was below the 10-day moving average of the market, of the sector, of the stock. Either or. Doesn't have to be all three. Number 2, when the VIX is starting to rise. You maybe start to get a bullish MACD divergence. If you start to see from an international perspective, the yen is starting to actually rise, which we are seeing, this is probably getting to maybe more protective type strategies. Okay. Now, James, why haven't you talked about protective type strategies so much? Well, it's because we've been going to the downside. That's why we've been talking about bullish positions, long positions, right? Now, let's go back to kind of what we wanted to achieve today, okay? Let's say we want to do a collar altogether. What does that look like? Now, what I'm going to do is I'm going to go back to a position, and let's start with kind of a stock that might be lower in price, okay? Now, this one supposedly has earnings upcoming, and I want to kind of start with a low-priced example. I could have sworn that was yesterday. It was supposed to be the earnings, but now it's showing the 29th. Remember, there's been some issues with this company. Now, I want to talk about this as far as buying the shares, selling the call, and buying the put together. What does it look like? Why would someone do that? Now, how many of you have ever been maybe nervous, you have earnings upcoming, and then you're hesitant on maybe taking a position? I think most of us would say, yeah, it's me. Yeah, I felt like that. Now, what I'm going to do, if someone does a collar, they're at least bullish somewhat. okay, you wouldn't do a caller position if you weren't bullish to some degree, okay, as you'll see in just a sec. So what we're going to do is we're going to go to the trade tab. Now, by the way, what I expect from you is I expect you to, alongside us, practice trade in the paper money account to see how this works. Now, don't worry about this position down here. Don't look at that. But we're going to keep it right there. That's the weekly option. And I'm just going to go ahead, if you don't mind, I'm going to take that off so it doesn't poke us in the eye with that percentage right there. But that's not the point of the conversation. But let me take that off so you're not enamored by that, because I'm not, okay? So I'm going to just buy that back so we just start fresh down below, okay? Now what I'm going to do is step number one, okay? Can you follow along? Step number one is I'm going to come to the ask price. Click on that. Okay, so that wasn't too bad. If we click on that, it comes down here, stock buy plus 100. Say yes if you're with me. Okay, that's not too bad, okay? Advanced order, we're going to go down to single order, and we're going to go first triggers SEQ. So all we're just saying is do this in order. Step one, buy the shares. Step two, sell the call. Step three, buy the put. Just in that order. Now, what we're going to do is when I pull this up, you're now going to see that when we talk about doing, let's say, a caller, okay, we typically like to have an expiration, maybe 20 to 50 days to expiration. Why not go longer? Does anybody know the answer to that? Why not go longer? Can anybody explain that to me? And this is an important one. Why not go longer? Okay. Now, what I'm going to do is I'm just going to bring up something as I'm getting the answer here. So first off, why don't we go longer? Well, if we come down here and we sell a call, okay, example given, the $39 call, the reason why we don't want to go out till, let's say, July of next year is we don't want to cap the upside for that long. We want this to be a shorter term right and obligation, not to something that's out till next year to July 4th, okay? And we have no clue where it's going to be next year in July. No clue. Now, what we're going to do in this case is we're going to come down to, let's say, I want you to think like a covered call, right? When you do a covered call, we talk about, hey, you might consider selling a call with a delta 30 to 40. Does anybody know why we actually talk about, for example, doing a delta 30 to 40? Why do we say that? Now, that doesn't mean that someone can't go outside that or below that, but typically when we're talking about a delta 30 to 40, it's just something that has a strike above where the current stock price is now. So if the stock is at 35 and we say, hey, I'm going to sell, example given, the $42 strike, we want there to be some upside on the stock. So if the stock is at 35 and we sell the 42, there's some upside stock appreciation potential, meaning we don't want to cap the stock out at like pretty much where we are now. If we buy the shares at 35, we sell to 36, there's not much upside, okay? Now, what we're going to do in this case is, now notice the implied volatility, 149, high implied volatility, bigger premiums. What I'm going to do is I'm going to go to the 42. We're going to click right on that. Now, remember, this will not work for you unless you come down here to the bottom, first triggers SEQ. Then click on the bid of that option. So this position right here, what is this position? What is this position? Shares of stock and you sell a call. What is this position? This position is just a classic cover call. Now let's bring it up on the fund tab. Is that really the name of it? No, it's not. It's the Analyze tab. Some of you are going, I hate the Analyze tab. No, it's the Fund tab, okay? So I used to be scared of the Analyze tab. Don't click it because it's going to make, you don't understand what it's saying. It's actually not as bad. Let me, as a neophyte, walk you through it, okay? So all I'm going to do is going to right-click on that line, we're going to say Analyze the trade. Now, when we do this and go to the risk profile, it's just going to show a diagonal line. It's just plotting the potential profit or loss if the stock were to go up or down $1. That's all that line is showing. Now, you're going to see that the profit loss right there on the left-hand side and the stock price in the middle, okay, or on that bottom there, okay? And right there, that's where the stock is right now. And this is kind of like playing the little theoretical game. Wonder if the stock goes up $1. Well, if the stock goes up $1, on 100 shares of stock, you'd be up $100. Stock goes down $1, you'd be down XYZ, right? That's all it is. Now, what we're really trying to get is look at the delta, okay? So the delta is really, in this case, on the stock. If you had 100 shares of stock, your delta is 100. Think of that as the rate of change in the profit or loss given a 100 shares of stock, given a $1 move up or down. Okay. Now let's kind of add to this for a second. We're going to right click on that, analyze. Now, when we do this, what you're now going to notice is this is now showing the position of the call option. And what you're now going to notice is that blue line, it's now capped out. Now, why would someone cap the upside? How foolish is that? Is it? Is it foolish? So you might be thinking, well, why would I sell a call at 42? And then you actually keep reading to the right, oh, for $2.18. It's really like you're getting up to 42 plus 40 plus 218 on top. So it's like you're getting up to 44.18. And then you ask yourself, what's the chance of the stock being at 44.18? Where'd you get 44.18? Take 42, add the 218, and it's 44.18. So the stock could go from 35 all the way to 44.18, and that's your maximum gain, whatever that number is. From 35 to 44.18, it's a $9.18 move, which is like 25+% in 20 days. And then someone says, okay, so maybe that's not a bad idea to cap it off, okay? But you got to remember is if you sell a call, they could take those shares from you at the strike price. From the time you place the order, and it enters all the way to expiration. But they still got to give you all the way up to 42 and give you all the premium. Now, if we look at a position like this, what you're now going to notice is how many of you would think about buying puts if the IV is 149? Now, I'm going to tell you right now, the human psyche is probably going to say, man, I ain't going to buy no puts for 23 days for $300. You nuts? Well, let's not go there. Let's not go there. Now, what you're going to notice in this case is you can have more of a skew to the downside. Why is there more of a skew to the downside? Well, the puts tend to be higher priced than, let's say, the call premiums, okay? Because there's more of a concern the stock could go to the crash to the downside than go to the upside. Now, what we're going to do is we're going to buy a put at about the same delta. We're going to look at the 32, okay? So now what you're going to notice is we have an obligation to sell the shares at 42. We also have a right to sell the shares at 32, okay? Now, what you're now going to notice is when I bring this up on the diagram, what does this look like? So if you look at this diagram, what type of strategy typically has a diagram that looks like this? What would you call it? Well, if you look at this strategy where you have a maximum loss, why does that line go flat at 32? Because you have a right to sell the shares at 32. Not theoretical, a right. And you have an obligation to sell the shares at 42, a cap, okay? And this diagram looks very much like, now here's the deal. Sam says, SMCI is not my first choice. The reason why I'm choosing SMCI is I want something to be volatile. I also want to start with a lower price dollar stock. It doesn't even matter which one we're looking at right now, per se. We want to understand the structure of the position, the profit and loss, and so on. So I wouldn't get so tied up in it. I wouldn't do it on this position. Trust me, we're going to do it on another one that might have a stronger trend. Noted. But if we take a look at this, what we really want to see is between delta, gamma, theta, and vega, which option Greek is substantially higher. It's not even a contest. So when you take a look at this, the delta of this position is about, let's say, 31. So what you're now going to notice is when you look at a standard caller and you sell like a 30 to 40 delta on the call side, and then you buy a 30 to 40 delta on the put side, and you own 100 shares of stock, your delta on a standard caller is going to be between about 20 to 30. Okay? So now let's kind of play the what if game. Wonder if SMCI goes up $3 tomorrow. Well, you get a 3-point move on the stock, and the delta is about 31. And so the profit loss should be right around potentially 93-ish. Okay? Now, what happens if that stock goes down $3? Well, the stock goes down $3. What's the delta? You're now going to see the delta is 31. We should be down about 93-ish dollars. Now, kind of what I think is interesting about a caller, as the stock goes down, the delta of the call goes down, or should. But as the stock goes down, the delta of the put rises. Why? Well, because there's a greater chance to be in the money. Why does the delta of the short call decrease? Because there's a lesser chance to be in the money. Okay? So as the call delta drops, the put delta increases, and it's more of an offset. And so this delta is most likely staying more stationary. Okay? So I want to do this example. Now, by the way, if we said, well, what is the most we can make? Does anybody know what is the most we can make on the position? Does anybody know that? And then what's the max loss? Now let's bring this up. So if we kind of take a look at this, let's kind of talk through this nice and slow. Just want to have a real understanding of what we're doing here. Okay, so what do we got? Let's do the basic math. If we go from 34.80 to 42, guys and gals, is that, let me make sure I'm right, what is that, $7.20? The stock could go up $7.20. Are you with me on that? About $7.20. 34.80 up to 42, about $7.20. Now, if we look at the debit, is it a net credit or is it a debit? Now, let's just say that this one, if you don't mind, it's $2.10. Well, it's not a net credit. It's a net debit. You got to pay this, okay? Got to pay that. And let me just take that out. This is going to be a minus. You pay that. And that $2.10, you collect that. So we have to subtract off $1 because the net is a debit. So the most we could gain is $620. Okay? Now, I don't know about you, but that's not bad. Okay? Now, let's kind of look at the opposite side of this. Wonder if the stock goes down. Okay, so let's look at this. So if we go from 34.80 down to 32, how much is that? $2.80. Okay? And then what was the net debit? Well, it's $1. Okay? And so if we said, what's the max loss given this trade pre-commission? It's $3.80. Now, do we have to worry about, oh my gosh, wonder if the stock gets cut in half? We don't necessarily have to worry about that because we have a right to sell it at 32. Now, I'm going to tell you right now, I think a lot of investors have not a clue on the power of the puts. The puts are powerful, but you got to remember you pay for them, and we're just using the call premium to help pay for some of the put. I think more investors would have more confidence if they realized they could limit the risk to the downside. Now, the other point to bring out here is this is not limiting the risk to infinite in time, right? This is limiting the risk to the 20th of December. Okay, so there's the difference. Now, what I want to do on this is, so we kind of talk about the max gain, max loss. Let's put some of these trades on here. So what I'm going to do is I'm going to come back to this, confirm send. Now, remember this diagram, maximum gain, maximum loss. What does the strategy look like? It looks like a long call vertical. It looks like a short put vertical. But what's the difference between the long call vertical and the short put vertical versus the collar? You got to own the shares. But if you look at this collar type strategy, it has a bigger delta. And this strategy is almost mimicking the delta typically of, let's say, a cash secured put. Now, notice when we do this, we have a commission to sell the call and buy the put. What we're going to go ahead and do in the margin account, we're going to send this order. Now, how do you really learn something? Gosh, you trade it, okay? Now, the biggest actually thing is we want to make sure that this position fills. If it doesn't fill, what I'm going to do in this case is I'm going to go ahead and tinker with the order real quick and just make sure that fills so that way we can kind of follow along with the example. Now, how many of you think, as a takeaway, that you could say, James, okay, I could do that. That's not too bad. I mean, I could buy shares of the stock. I could sell a call. How many of you think that that's not that bad? Okay. Now, what I'm doing is I'm just trying to see if I can get that position. I'm moving the prices around just pennies. Okay. That one, 10 cents. And so now what you're going to see is there's the shares, there's the short call, and there's the long put. Now, at first, we're just going to kind of try to play them out. We're going to try to hold them all the way to expiration. But the goal is maybe even what percentage of the maximum gain could we get? So you might say, I'm not going to hold the expiration. If I get 50, 65, 80% of the maximum gain, I'm going to go ahead and take it off the table. Okay. I just want to go there, but that's not where we're going to be right now. Now, let's imagine someone says, James, you know what? I don't really want to do that on a stock like SMCI. I started there because you learn how to swim, not in the 8-foot mark of the swimming pool. You tend to actually learn in maybe a lower price dollar stock or a shallower end of the pool. Okay. Now let's kind of go to the bigger stock now. Let's say the investor says, James, I want to be bullish Apple, but I'm a little concerned. Wonder if it doesn't break out. Wonder if it pulls back. Okay. Now let's show this. Now, what I want to do is I'm going to ask you an in-class quiz on how do we do it, because I just want to make sure you know how to do it. Now, what I'm going to do is I'm going to go to the trade tab. Okay. I'm going to go to the trade tab, and this shouldn't really be that bad, because if we go to if, for example, we come in and say, look, I'm going to buy the shares of stock, not that bad. Click on that. Okay. What do I do next? Well, I got to go down here to the bottom left, and I got to click on where it says single order. Tell me what to type in. First trigger is SEQ. Okay. Now, when we look at the time frame, right? When we go to that time frame, 20 to 50 days to expiration, we're still looking at that same time frame. What strike are we looking at? We're going to look at the one that has the 235 strike. No, we didn't say that. We're trying to have something a little bit higher up, maybe delta 30 to 40, so there's some upside potential. How do you actually sell that? You click right on the bid. Okay, there it is. Now you're going to see that there's your covered call. And then step 3, we're going to go over to the put side. And now what you're going to see, if we picked one that has a delta of 30 to 40 on the put side, we now have a delta of, let's say, 230. Okay, we're going to click on that. So notice here, this is more normal of what you're probably going to see. Meaning, if we sell a call, the credit there is going to help to pay for all of the put. Usually the credit on a caller, or I should say the net effect, is usually benign. It's a no-cost caller. The call premium is going to be paying for the put premium, or very, very close. Now, you got to remember what we have here. We actually can make from 234.66 up to 240, okay? And then there's no net credit here, pretty much. It's flat. So the maximum gain is from here to there, and the maximum loss is from here down to there. Run the numbers. So we don't need to be scared. I'm scared, okay? Scared of what, okay? Because when you really look at this, the investor is buying the right to sell the shares at 230, but wonder if it goes down to 130. Well, the investor has the right to sell the shares at 230 from now until expiration. How many more people do you think would actually trade or invest if they realize they kind of they limited the risk to the downside for a certain length of time? And I think this is a nice strategy to kind of practice to begin with, to kind of get your feet wet on this and then hone your strategy. Sell the call, buy the put, noted there. What we're going to do in this case is we're going to send that. And now what you're going to see is we're going to make sure that position fills. So what we did here, and I want your homework to be, if we did all together, we did examples of SMCI. And then what we also did here in this case is Apple. Okay. So those are the ones we did here. Now the leg into a collar, this is where the technical analysis has become weaker. Now, the example that I would like to look at, so this leg into a collar means that we already own the shares already. Okay, so if I went back to, let's say, a position, I want to make sure that that fills, and I'm not seeing a fill yet. And so what happens is when we talk about it, okay, the prices are moving and they're playing games with me and they're just trying to annoy me. Okay, that's what it feels like. Now, okay, so now you finally, okay, so 100 shares, there it is. short the call and buy the put. Now, your homework assignment is I want you to go out and I want you to do one yourself in the paper money account, okay? Now, if you want to follow us along in the SMCI and the Apple position, fine, have at it. Just remember, we're trying to learn together, so when we come together in class, we can talk about the examples. And I think it's helpful if it's on your side as well in the paper money account, then it's not like just this one-off trade I'm talking about that's on the paper money account, and you're not following along. Okay, now, I'm going to bring up in the paper money account XOM, and is it in the margin? No. Is it in the IRA? There she is. So we have 100 shares of stock. What do we mean by technicals are weak? Well, if we go up to the charts and we look at this, what we're going to see is what might trigger the investor to say, you know what, don't like the trend right now. Well, number one, it's kind of been carving or forming a level of resistance. Okay, now that's not great, okay, because if you can't get past the resistance, maybe the price falls back or flattens out. Now, if we have a call and the stock goes sideways, that's not necessarily hurtful, okay? But the biggest actually thing is here is the concern is, does it pull back? And that's where if the investor starts to see on the chart the two red lines on the moving averages, they might say, I now want to go in and protect my shares. Now, what you're going to notice is if the investor does not protect the shares, what happens is if they have, let's say, 100 shares of stock and a gain of 342, if the stock goes down $3.42, they give it all back. How many of you have ever had a situation where you're like, I was up a couple $100 and then I gave it all back? And then it's like sad. I think we've all been there. Okay. Now, so if the investor says, James, I don't normally notice a pattern that when the lines are red on the moving averages and there's been a cross, that is usually not a good recipe for like making money. I tend to give it back. Okay. Well, now let's do this. We're going to go right back into the 20, 50 days to expiration. We have the shares already. This is what we call legging in. Now, what we're going to do is we're going to go to the delta 30 to 40 again. Now, if we have the shares already, all we need to do is right-click on the call that you want to sell. We're going to now go to where it says call or synthetic. Okay, have the shares already. Right-click on the call that you want to sell. Go to sell, call or synthetic. And now what you're now going to see in this case is we're selling the 221, and we get to now pick, well, which put has a delta of 30 to 40. Well, the one that has that is the 116. All we're going to do is going to come down to the 116, and let's just change this. Now what you're going to see is the call is up to the 121. Stock is at 118 and change. It can make up to the 121. So there's still some upside potential. The downside, okay, if you take a look at this, is the 116. And so that's the right to sell at the 116. And so now what you're going to notice is, what is the cost? Well, we don't have a cost. I would say there's more of an opportunity cost and a commission. The opportunity cost is the 121. You're capping that out in the short term, and you're paying a commission, noted, 2 of them, for selling the call and buying the put. And you're going to see that if we sell this, now what you're going to see is we've actually turned the position from 100 delta now down to a delta of maybe about 30-ish or so. Now, so we can get that position to fill, I'm just going to go in here and kind of maybe go mark it so we can see what this fill looks like. Now, remember, let me ask you a question. This is key. If your delta goes from 100 down to 32, why would someone do that? Where do they think the stock has a greater chance to go? Well, yeah, if you go from 100 delta and now your position goes down to a delta of 32, what you're really saying is, I think there's greater odds of the stock going sideways to maybe pulling back down some. And by having a lower delta, you're trying to be stingy in a good way to give back that profit that is unrealized. Go back. If you have a lower delta and the stock drops, well, remember we said before, if you have a $342 gain, all the stock would need to do is go down $3.42. If it goes down 342 cents, that unrealized profit is gone. Well, if you looked at this, if we had a $342 gain, okay, we had a $342 gain and the delta was, let's say, what, 33? The stock could go down $10, not $3.42. It could go down $10, and then we would be giving back the bulk majority of that. Now, here's the deal. This is what we call giving that unrealized profit back slowly, okay? Now, I used to kind of say that if you're going to take that money, if you're going to take it out of the hands of this paper money account, you're going to have to pry those fingers open to get that out of this account. However, a lot of investors, they just have their hands wide open, no protection at all, and the market just grabs it from that investor and says, thank you very much. So protection strategies is about learning when to alter the delta based upon the technical analysis. Now remember, don't confuse, don't make it hard, okay? If you start to see resistance, if you start to see, for example, the moving averages going red, price below the shorter term moving average, don't forget that. That's typically not a recipe for making money in the short term. It tends to be a recipe for giving it back. Now, I'm not going to get into this, but I'll speak to this. James, what if the stock goes to the upside? Can I buy the call back? Sure, but you need to see the liquidity, okay? But you could say, look, I want to uncap that upside. Well, to uncap the upside, what you just need to do is just buy the call back. Now, if that stock goes back up quickly, okay, and it goes up quite a bit, the call is going to be losing money, or should be, but the gains are in the stock, okay? So you won't be making as much as if you just own the stock, but you got to remember is you're going to have a loss in the call, or should, and the gains are going to be in really the shares. Now, this kind of brings up the question, but why would you do this strategy versus just getting out all the time? Well, if you sell all your positions every time the moving averages go red, you're going to be getting in, out, in, out, in, out, in, out, in, out, in, out. And you're going to be like, wow, I just don't really, I don't really have any long-term holdings, okay? So what the investors try to do here is when there's short-term negative price momentum, they're trying to use callers to overlay on their stock positions, and they're also maybe trying to, at the same time, ride that longer-term intermediate trend and maybe try to get the dividend, but in the short term, be stingy with giving any of those unrealized profits back, okay? Now, it's up to you. If you just want to give it back, you don't need to listen to anything further in this class. But if you want to try to be a little stingy to give those unrealized profits back, this class is kind of interesting. Now, what I want to do is I want to go back to just real quickly speak to, let's say you had a stock, and you said, James, I want to actually I have a stock position, and let's go back to an example like Mo. Now, Mo has been a horse, and I have a target. Let's say the investor says, if it goes up to 58, then I want to put on protection. Okay, so instead of selling the stock up near the target area, you're wanting to apply the protection, and then what you're trying to do in that case is you're just saying, look, I want to try to hold my unrealized gains so those short-term traders don't come in and really use my stock as a piñata to take to push the price down. Makes sense. Now, how would the investor do this? So let's say the investor says, James, I'm sitting on some shares of stock, and I think my price target, the investor says, is $58. Okay, fine. So what strike is above the $58 threshold? Well, if we go up to the 58, what's the strike above that? Basic math now. If we go to 58, the strike that'll be above that is 59. Congratulations, we did it all together, okay? Now, if the stock goes to 58 on the put side, what's the strike below that on the put side? Well, okay, so if we go to 58, it'd be 57, 56, 55, okay? So we're probably looking at selling the 59, which is one strike above the target, and we're buying really the put below the target. Could be 56 or 57. Now, here's the problem. A lot of us, we kind of we fall in love with these little profits, like, ooh, okay, but that's really not the point. We want to have a plan and think ahead of time. If you do that, you're going to probably be ahead. Okay. We're going to right click on the call that we're going to sell. We're going to go to where it says we're going to go to where it says call or synthetic. And if the stock goes to 58, we're going to sell the call strike that's above the target. So there's still some upside. Now, if the stock goes to 58, the put strike that would be below would be 57, 56, and so on. If we choose, let's say 56, we're just going to have this order pending. How do we do that? Now let's close this out. We're going to go limit, market, data GTC. Okay? Now what we're going to do is we're going to click on the gear. And if we click on that gear, what we're now going to see is it's going to show, we're going to say now symbol, Mo, method, greater or equal to. And we're going to say, Mo, if you go up to 58, enter the caller, change the delta. I don't want to have high exposure when those short-term investors are likely going to come in and sell, and hammer my profit. I can at least say sorry, right? So now what you're going to see is if the stock goes to 58 or higher, it now, for example, enters the caller. Now, could you do this the same thing on the downside? Of course. Okay, save the order, confirm send. And now what you're going to see is this will say illegal if you do not cancel the stop. So all we need to do is cancel that stop and the target, and we're just going to put this on and close this out, and there it is. Okay, now your homework assignment, I want you to go out and practice callers entering all at once. Second, I want you to practice legging into positions, legging into callers, where the technical analysis is weakening. Last, I want you to go out there, if you say, James, I have 100 shares, and I want to practice putting on a conditional caller if the stock goes to my target. Okay? So I'm out of my time here today. I want to say thanks to Brett for answering those questions in chat. You guys have been a lively bunch. I also want to wish you a happy Thanksgiving. And this class has also been recorded, so you can go back and review it as well. I think the strategy is kind of pretty important, okay? Obviously, you can tell. And also remember that review what the pros and cons were as well. So remember, with what we talked about, all investing involves risk. I wish you a happy Thanksgiving. Ben Watson should be back next week, but this has been in the class of Protected Strategy. Happy Thanksgiving, and I'll be teaching on later today. Take care. Bye-bye.